So you found the right video, because in this video, I'm going to show you as an absolute beginner how to start investing. First things first, as a complete beginner, what on earth is investing? Essentially what investing is that you put your money now into a company or a bunch of companies with the hope that the company is going to be profitable in the future, and they will share some of that winning with you in the form of a higher valuation when it comes to selling these shares that you have of these companies. You should also know that the stock market as a whole overall does seem to always go up as the years go on by. This is to do with many things. Number one is GDP. So the gross domestic product actually increases as there are more people, there's more production of goods and services. The other thing is inflation. As inflation goes on, things become more expensive. This passes on to the stock market, meaning that a company that is valued at X, if they're doing well, they still remain profitable, they'll be valued higher than their initial amount. And that's where you come in as an investor. As a beginner investor, it's very important to realize what is realistic. So this is not going to be one of those trading videos where you're making £1,000 per day from an initial balance of £100. That's just not going to happen. Realistically speaking, the S&P 500, which is the collection of the top 500 companies in the USA and is a benchmark for the total stock market returns, that has averaged over the past 100 years around 9%. And in that period, it has beaten inflation almost every single year. Now, usually inflation is within 2 to 3%, but recently we have been seeing inflation as high as 10%, meaning that if we don't put our money into something that increases above inflation, what we're going to see is the value of our money within a bank account or anywhere we store them to be a whole lot less, and essentially we can buy less things with the amount of money we have. So therefore, investing is important if you want to beat inflation and also grow your long-term wealth. That comes into another point, is that we need to be realistic about our time horizon. If you're thinking that investing is going to make you the next Warren Buffett in less than 10 years, that is absolutely not going to be happening. What you need to realize is that if you do want to grow your long-term wealth from Christmas Day to day until when you retire, you're looking at a minimum of 10 years in the stock market, as we tend to see every 10 or so-ish years a big drop-off in a stock market known as a stock market crash. During those times, people tend to sell out because of fears of other things happening in the economy, such as a recession or something very unpredictable like we've seen in 2020. So for that reason, if you do want to grow your long-term wealth, we're looking at about 10, 30 and hopefully 40 plus years of actually putting money in regularly and changing around your money habits. So instead of having short-term gratification, you're looking at delayed gratification, where the endeavors that you do now pay off in the long run and you're in a much better position in the future as opposed to now. So all these things being said, what is the first step that we have to do now that we have our Nan's £100? What do we do with this cash? So most likely your Christmas presents are probably in cash. So what we'd want to do first is, of course, deposit that within our bank account. And because everything is digital these days, we're going to be working on credit of £100. Now, the next thing we need to do with our money is to find a suitable stockbroker. In short, a stockbroker is a provider that is going to allow us to buy stocks and shares. And in the UK, there are many different providers, but it is important to know that different providers have a very different amount of fees that you're going to be paying for them, and also other services that you're going to look at that you might actually not need. For me, there are two most important things to look out for when looking at a stockbroker, and that is the fees and the security. So we're very lucky these days because we have a range of options to choose from of stockbrokers that allow you to buy stocks and shares from them with very, very small fees and zero commission. It wasn't too long ago that when you wanted to buy stocks and shares from a company, you'd have to go through a broker, which is the middleman. They would charge a hefty fee on every single trade that you placed. These days, a lot of providers actually provide zero commission. They do have some fees, but they're very small compared to what we used to have before. So like I said, the second most important thing is safety. There are a lot of dodgy stockbrokers out there that aren't even regulated by the government. So at bare minimum, you're looking at FCA regulation, which is the Financial Conduct Authority in the UK. This is a group that ensures that dodgy stuff aren't happening with your money and that your money is separate from the company's money. And by law, that's what they have to comply with. If something bad happens to the company, then at least your money is separate from their money so that they can't have access to it. We've seen in America with companies like FTX US how customers' deposits can easily be frauded and taken away from them if they're not complying by these strict regulations. So by bare minimum, we're looking at FCA compliance compliant. So if you're looking for a stockbroker, please at the bare minimum see that they are FCA regulated. The second is that you want your broker to be FSCS regulated in the UK. FSCS stands for Financial Services Compensation Scheme, and in the UK, any account that you have, for example a bank account or even a stockbroker, cash up to £85,000 is protected in case of an emergency and the company that you're dealing with goes under. There are dozens of stockbrokers within the UK offering very good services. However, as someone who has been investing for a while, I've looked into all the platforms, and as a beginner I can only really recommend two platforms, and they are named Trading212 and InvestEngine. Now these two platforms are quite different in the way they work. So Trading212 offers no commission and very low fees. For example, if you want to buy a company that is in the US, you pay a very small charge converting your money from pounds to dollars. The other is InvestEngine. They also offer no commission and they don't really have fees, only allow you to invest in something called an ETF, and they will be already in pounds, so there's no need for currency conversion. If you want to start your Christmas journey into investing, I have the links to the best brokers that I personally use and recommend in the links in the description down below. If you sign up and top up their minimum required amount, you will receive a free share. Bear in mind that these are just my recommendations, and I implore you to do your own research and find your own stockbroker. I would be more than happy that you did your own research and you are with a stockbroker that you are personally comfortable with, because at the end of the day it's personal finance and I cannot tell you what to do. So for the example of this video, we've chosen our stockbroker to be Trading212. However, before we even start investing, we need to realize the different type of accounts such platforms have. So this is my personal Trading212 account. As you can see, I've been investing for over a year with them. If you download any sort of broker like them, most of the features will be very similar. However, in the UK there are two main types of accounts. Not every single broker offers the second type. Generally speaking, when you open up an investment account, you have what is called a general investment account. And on Trading212, this account is called Trading212 Invest. Within this account, whatever profit you make is liable to you paying your own tax via self-assessment. From next year, the capital gains allowance is going to be £3,000, which means that if you make more than £3,000 in profit from selling off a stock at a value more than you paid for, then you will have to do your own self-assessment and pay your own taxes, which can be very complicated for most beginners, and it's not something that I can cover as it's very specific to you. The second type of account that stockbrokers offer, for example Trading212 and InvestEngine for free, is called a stocks and shares ISA. Now Trading212 calls it the Trading212 ISA. Most providers will call it an ISA in some sort. Now it is very important, if you're investing and you are based in the UK, to make full use of a stocks and shares ISA. So you may already have a cash ISA, but every year each individual within the UK has a £20,000 deposit allowance towards these ISAs. Whatever money you gain in terms of capital appreciation, so if you make a profit in selling off any of your stocks, you do not have to pay any tax, and you don't even have to do your own tax return, because any money gained within these ISAs are completely tax-free. Now if you don't have an ISA elsewhere and you want to start your investing journey, I always think it's wise to actually think about opening it within a stocks and shares ISA. From April 2024, you can open as many stocks and shares ISAs as you like. So unless you're watching this before then, you can only deposit into one per tax year. So once you've signed up to your selected stockbroker, what you first want to do is to deposit your funds. On Trading212, for example, you can press the menu button, which are the three horizontal lines, and then you'd want to go to deposit funds, although depending on your stockbroker, these steps are going to be slightly different. So once we're in deposit funds, what we have to do is link our bank account and get that £100 from our bank account into our stockbroker account. I have already linked my bank, so I'm not going to do this step, but once you link up your bank account, you can deposit from your main bank account into your available funds so that you are ready to invest. Now, as a beginner, you may be confused as to what to invest, and this is where most people actually lose money, because they invest into companies based on what their friends are saying, what the news is saying, and what random YouTubers like myself are saying. I actually don't ever recommend what to invest in, and I never will, so please don't comment that down below. So the premise of the stock market is that you can buy shares in a company. So if I press this magnifying glass here, which takes me to the search, you can see that there are a number of familiar companies that we can invest in, for example Tesla, Apple, Amazon. And here is where the difficulty comes in. As a beginner, you really don't know what to invest in, and you really ought not to take advice from people who have absolutely no idea where the stock market is going, and that is 100% of all human beings. It is impossible to actually predict where the stock market is going, so there's no point of listening to someone who's saying, for example, Tesla is going to double in share price by next year. But in either case, here are some very popular traded stocks. In the search bar, we can can find out our own stocks if we wanted to invest into them. For example, if we wanted to invest in AMD, we can just type in AMD. Here we see on the top advanced micro devices, and we can go into that company. Now, what's important is that we have a graph here, and this graph shows the movement in the share price throughout the selected time periods. You can see that this company AMD over the past year is up by 112%, which means that if you invested exactly 1 year ago into AMD, you put in £100, that £100 would have more than doubled, so you'd have around £220. Usually companies don't go up that much, and if you think that it will continue going up by 100% each year, then you probably are going to be in for a shock. Like I said before, 9% every single year is an extremely good thing and very hard to achieve in picking individual stocks. So the main principles in investing is to invest into a company that is going to be profitable in the future. Now, there is no guarantee if a company is going to be profitable in the future. The only ways in which we can actually be more sure of our decisions is by looking at the company financials. Now, some of these apps do have built-in financial statements. However, I would do my own research in an external platform, as these are never very detailed at all. And learning all about a company takes hours and hours of skill, and there is only one person on the internet that can actually do that.
Hey guys, it's Sasha.
But in either case, what we have access to as investors are the public documents that these companies have to file as part of the law. We can see the financial statements for AMD, for example. Here we can see that their revenue from 2020 to 2022 has increased dramatically. Now, just because the revenue has gone up now doesn't mean that it will continue to go up, and that's why we need to dive deeper into what the company really is doing. For example, we can look at their balance sheets, and like I said, this is just an at a glance thing to look at here. For example, we're looking at the balance sheets, which is a very simplified version of the actual balance sheets. We can see that the company's assets are growing tremendously rapidly, and the liabilities are also much less than the assets. Essentially, what an asset is how much you have worth of something that you can actually sell if you needed, and a liability are all your costs. So if a company has more costs than they're actually bringing money in, that company is no longer profitable. And as a result, shareholders will know this, and they will take their money out of the company, because at the end of the day, this is the stock market. If something is low in demand, the price falls, just like the price would fall for pasta, for example. If the demand is high, the price is high. So essentially, if you're investing for the long run, if a company's demand increases because they seem to be profitable, the value of the company will increase. And if you sell at a price that was higher than what you bought it for, you are essentially making money off profit. Now, the second way that you can make money off the stock market is by investing into companies that do pay dividends. Now, a dividend is a name for a payment that a company pays to its shareholders when it receives lots of profit and wants to give out something extra to its shareholders, essentially. For example, Johnson & Johnson, one of the most reliable dividend payers in history, pay out a dividend yield of 3%. Essentially, what that means is however much you buy the stock for, 3% of the value of that stock is going to be given out per year as an annual equivalent to its shareholders as a thank you for holding onto its share. So passively, you are making some money by holding on to the stock and not selling it off. As a beginner investor, you do not ever want to withdraw your money early, as it means that the compounding effect that you're going to see from keeping your money in a long period of time is going to be eroded away. So it's nice to receive dividends and the value of your portfolio to go up. Now, this is what I mean by portfolio. So the portfolio is the total value of all the stocks you hold within your account. The value of this portfolio can go up and down as the value of your stocks that you hold within your portfolio from a minute by minute basis. Now, investing in the stock market is not an easy thing, and especially investing in individual stocks, there can be a huge risk that I haven't spoken about until now. Now, for example, if we invested all our money towards AMD, we are exposing ourselves a tremendous amount of risk. Now, like I said, there is no guarantee that AMD will continue to become profitable, and in the future, more than likely at some point in the future, they will be dropping their share price. For example, back in November 2021, the share price was $155 per share. By October 2022, the value of their shares have halved to around $72 per share. This means that if you put in £100 at the peak, the value of your portfolio would be £50, something that most investors cannot stomach. So what people tend to do is that they sell at a loss. So they actually sell at £50. So that's a £50 loss. Once you sell, that is it. You can't actually get that money back. So what would have happened is if you kept on investing, the share price would have gone back up. And if you had invested regularly, which is called dollar cost averaging, you would have bought all the way when it was going down, and you would have benefited from the interest that you get when the stock price climbs back up. So I have have given you so many terms so far. We've already talked about dividends, we've talked about capital growth, which is the growth that we see in the value of our stock, and we've talked about the risks of actually putting all your money within one company. Now, the other thing that could happen to AMD, for example, is that it goes bankrupt. In the event that this company goes bankrupt, or any other company that you have your money in, you lose all the money that you've invested into that company as the value goes all the way down to zero. This means that if you invest in only one company, your risk profile is very, very high. Essentially, you put all your eggs into one basket, and that is not something that you want to do as an investor unless you're 100% sure that this company is going to go up and up forever, which is very unlikely that you know that is the case. So because of this risk, investors tend to invest into a range of companies so that if one or two companies actually goes bankrupt, they still have money in their portfolio for other companies to actually pick up the slack and for them not to lose out on all their money. So as a beginner investor, one of the most important things they can learn is about exchange traded funds. So I've typed in ETF into the search bar, and what an exchange traded fund is a basket or collection of stocks. For example, here we see the Vanguard S&P 500, which is the top 500 companies within the US. So this basket contains over 500 companies. So if one or two or even 10 of these companies go bankrupt, you're not going to be losing out on all your money. Another thing an ETF gives is it gives you exposure to a certain sector. So for example, the S&P 500 gives you exposure towards a lot of the technology sector. It gives you exposure towards the United States of America and a lot of the Western developed world. We can see that since November 2017, this ETF has gone up by 186%. If you had consistently invested into this ETF, as you can see, the trajectory has been upwards. Like I said, the stock market overall, including the S&P 500, always tends to trend upwards. That is what investors try to do, is they try to keep investing into good companies, and as a whole these companies will grow in value, and the amount that you have is more than likely going to be beating inflation. Now, like I said, an ETF allows you to invest into multiple different companies. This means that your risk profile is a whole lot less. However, even with an ETF, you can see there are periods where they do dip quite a bit. So that is why it is very important to understand that you need to be a long-term investor. Over the past 3 months, for example, even though the S&P 500 is up, it saw a bunch of dips where your money could go down 10% within a matter of weeks. But in the same vein, it could go up 20% in another matter of weeks. So with your £100, you can actually buy into shares of something like the S&P 500 or any other ETF that you choose to do so. If you invest regularly, let's say £100 per month, you will be buying when the market is at a high and when the market is a low. And within 10 or 20, 30 years, the value of the market currently is going to be expectedly a lot higher than what it is now. For example, in 30 years, the value of this fund could be £160, for example. So no matter what price you bought it for here, even when you thought it was very low or even when you thought it was too high, that doesn't have any comparison to what it is going to be in the future, hopefully. But ETFs don't just stop here. There are so many different ETFs that track many different markets. For example, the developing world, Europe, Asia, certain sectors such as the technology field, ESG, anything you can name, there probably is an ETF for that. If you want to just invest in ETFs, you can try out InvestEngine, which has the lowest fees for ETFs, even lower than the giant Vanguard. There are over 590 ETFs that you can choose from. And if you want another video explaining more about these ETFs, check out this playlist over here. Make sure to check out some of my other videos, and I will see you in the next video.